Hello everyone and welcome to our podcast on Matters Financial. Today's subject is on retirement planning. Our guest speaker today is Marcus Pilkington, one of our senior advisors. Marcus, would you like to tell us a little bit about yourself?
Thank you, Stuart. Good morning, everyone. I've been a financial advisor now for probably over 20 years. I've been at Pareto for 7 years. I'm a chartered financial planner. I'm also a associate trust estate practitioner through STEP. I'm also involved in setting questions as an examiner for the Chartered Insurance Institute, which is the examining body for financial advisors across the UK.
Great, thank you. Very impressive. And why is it so important to save for retirement, and when should people start to think about saving for their income needs?
Yeah, it's a good question. I mean, ideally, you start looking at it sooner rather than later. Obviously, we're in an environment at the moment whereby the cost of living is extremely high, and probably one of the first things that people start to stop doing is saving or paying into their pensions, and obviously that can have a much longer term impact on their retirement planning. So it's sooner the better. It's making sure, really looking at your position now, where you are, when you ideally want to retire. It's looking at your funding at the moment, as I said before, looking at your asset base, looking at future benefits that will also potentially come into payment, such as the state pension and when that is. And obviously we've got an issue with that's potentially going to be being pushed to later ages. So it's really essential to do it sooner rather than later, because you've got a much better idea of where you want to be when you want to retire. And obviously putting a plan into place sooner rather than later is really essential for everyone nowadays.
And there is a rough rule of thumb: for every year you leave planning for retirement, you have to increase your contributions by roughly 8% just to keep on track with that loss of the 1 year. So it truly is the earlier the better, isn't it?
Correct. And what we often find, particularly with business owners, is they are, for example, reliant on the business to fund their retirement. Now, things change. The value of the business may not be what they think it is. They then they start to fund their pensions later. And by making large contributions later, there's obviously less opportunity for growth. You aren't going to make as much. And then the sooner that you start on drawing on that money, then you've got issues there. Whereas if you take someone who's a lot younger, starts to pay on a monthly basis, they start to increase those contributions over 20, 30, 40 years, they're potentially going to be in a much better position because they've started to do it earlier rather than leaving it into their, potentially into the 50s.
And it's a good point with regards to business owners, because as a business owner, it's one of the most tax efficient ways of saving up, isn't it? Would you just like to run through the tax implications of paying into a pension?
Yeah, particularly for a business owner, is they are able to make quite significant contributions. The business can receive corporation tax relief on that, and as we know, corporation tax is only been going up. So it's a significant cost saving for the business. It's a way for the business owner to extract money out of the business without potentially paying higher rate dividends, as most business owners will take normally dividends up to the higher rate threshold, so they're only paying 8.75%. Above that, it's a significantly higher level of tax that they pay. So by making the contribution, it's a way of funding their retirement, it's a way of reducing the corporation tax liability, and it's also a way of them minimising their own personal tax liabilities as well.
Good, thank you. And what do our listeners need to consider when they're thinking about retirement?
I think there's a whole host of things that you really need to consider. Where we start is your current assets. We look at what's been paid into those assets. We're looking at when you're looking at retiring. We're looking at, for example, if it's a couple, state pensions, when they kick in. We look at a detailed income and expenditure analysis, and we try and work out how sustainable that is. Typically what you'll see is when you retire, you might spend more. For example, if you retired at age 60, you may spend more between the ages of, let's say, 60 to 70. As you start to get older, you then start to spend a little bit less. You've then got state pensions that have kicked in, and then your spending invariably will reduce the older you get. And it may only increase in your 80s, for example, when you've got long-term care planning needs to meet. So It's really about looking at where you are now. We use quite detailed cash flow analysis based on a number of assumptions to predict that forward. And then obviously a crucial part of that really is to do the ongoing reviews, be they every 6 months or every year, to ensure that the plan that we've put in place for you continues to meet what you're actually looking to do in the future.
And we do have a separate podcast on cash flow planning, but you mentioned it there, Marcus. It's quite important because people don't really know how much they need to save up for retirement. So one of the biggest questions that we get asked is, how much will I need to save up for retirement? So is there anything our listeners should be thinking about in terms of how much they need to commit to?
I think it's a bit of a reverse way of looking at it, but you have a look forward and you think, right, ideally what age do I want to retire? How much in a pot in terms of my assets, my overall assets, will I need from those assets to generate my desired level of income? We can then work it back based on what you're currently doing now. And the purpose of the cash flow really is to highlight you may be in a significant shortfall, so you may be way off where you want to be at a particular age. So it may be that you need to pay in more, you need to work longer, adjustments need to be made along the way. For some clients that we sit down and look at these kind of aspects with, is they actually find out that they can sometimes retire early, that they've got more than they thought, that the funds will last throughout their lifetime. So there are various different aspects of it, and obviously everyone's different because everyone's got a different asset base, they've got a different income need, and they've got a different date when they went to retire as well. So it's very much bespoke to every individual that we run through the cash flow analysis with.
And I know it sounds obvious, but a cash flow plan may highlight if a client isn't saving enough to achieve what they're looking to do in retirement. What the implications of not being able to save up enough funds to be able to provide and maintain the standard of living?
I think it's obviously at the moment there's quite a lot of people who are working far longer. A major issue we've got at the moment is the normal retirement age to take pension benefits is 57 and the state pension age is currently 67. A concern, obviously, given the amount of people that are receiving the state pension at the moment and the increases that we've seen in recent years, is that if they start to increase the state pension age, they will then subsequently start to increase, likely because it's linked, is the age at which you can take your normal pension retirement benefits. So as well as paying into a pension, which is obviously, it's critical and it's a really important part of pension planning, is that having other assets, having investments, other funds, cash. People have properties, other assets that you can draw on if you are looking to retire sooner rather than later. And it's not ideal. It's not something that everybody can do. But really, it's just about looking at your overall asset base and just making sure that you're contributing the most that you can possibly can to make sure that you don't get caught out in later years and that you end up working into your 60s or into your 70s, which is what some people now seem to do.
And I think it's worth mentioning, you said that people may have other pensions. They may have historical pensions, legacy pensions. It's worth us reviewing those because we might be able to save them money and possibly get them a better return on their investments. Would you agree?
Yeah, correct. I mean, we've got numerous clients, and I'm sure there's people listening that will have had various jobs, some in the 20s, some in the 30s, some in the 40s, and they just leave those pensions and they're just left. And then they only really look at them 2 or 3 years before they retire. A lot of the new modern contracts that we have are very well costed. A lot of the older contracts, higher charge contracts. There are things you have to be aware of. There are certain plans that may have some form of guarantees involved, or they may have higher tax-free cash entitlements that current pensions don't offer. So as part of the review, we have to look at any of those benefits that are in place on those plans. If you transferred them out, they could potentially be lost, but it's always worth reviewing your pension plans, and then you've got a much clearer idea of exactly what you've got, where it's invested, how it's performed, and obviously that's then incorporated into the financial plan for you going forward.
Great. Well, Marcus, thank you for your insight. So just to summarise some certain aspects for our listeners to take away, what would you say are the key factors to take away for our listeners?
I think number one is if you can, start as soon as you possibly can. Be aware of what you've got now. It's quite hard to predict what will happen in the future, but have a look forward, ideally when you would like to retire. Is that realistic? Is that affordable? Is it something that you can achieve? If you've got that plan, we have advisors like myself where we sit down and we talk through that in detail. But really, it's about being realistic in terms of where you are financially, individually, looking at your overall asset base, and it's just really starting off the plan and the aspects like the cash flow forecasting that we review sooner rather than later.
And we're quite happy to look at that review for retirement planning on a fee-free, no obligation basis.
Correct, yeah. And if we often do that for clients, we would, for example, if you've got 5 or 6 different pensions, we can write off, we get the information, and there's no cost to do that. If there is something that we can do for you, then we will obviously highlight that for you. But if some of those plans, like I said before, have something attached, there's guarantees, we may potentially advise you to retain those for the benefits that you've got. So again, it's always worth a call or a chat with one of the advisors, because there's invariably something that we can do to help.
Great, thank you. On a more light-hearted note, with regards to the podcast, if you could do anything and money was no object, what would you like to do?
I would probably have to say, having just been on honeymoon to Thailand, where my daughter fell in love with the country, ideally I would like Pareto to open an office in Thailand so I could go and work abroad and I could work near the beach. That would be my ideal scenario.
Well, I think you'd have a lot of your colleagues wishing to come and join you. So, Marcus, thank you, and listeners, thank you for listening. This podcast is part of a series we have recorded. Please make sure you subscribe and check out our other podcasts on certain aspects such as who Pareto are, estate and tax planning, protecting your assets, growing your wealth. We mentioned cash flow planning, which is fundamental to retirement planning, protecting your business as a business owner, and employee benefits and exit. As always, the information provided on our podcast is general in its nature and should not be relied upon without seeking specific professional financial advice. If you'd like to speak to any of our advisors regarding your personal circumstances, please feel free to get in touch with us for a fee-free, no obligation consultation. Thank you for listening.